I guess I'm just interested in the signal you think the bond market is sending you.
Well, I think it's sending the message that we had an incredible bond market rally this year, unanticipated across the board, whether it was treasuries, investment grade credit, high yield, emerging markets, everything rallied, in some cases double digits. And we're having a bit of a pullback in the sense that a lot of the news which drove this, particularly in September, where we had this Fed delivering a third rate cut, a lot of negative dynamics coming about through trade negotiations and the status of the trade war at that point. And treasuries hit 150 in that sort of neighborhood. And that was probably too low. The maximum pessimism we had, or optimism about what the Fed would deliver. And now we're kind of unwinding it. Remember, in November, we had it back up about to these yield levels. So I think at these yield levels, we're getting to the point of inflection point. This is sort of the top of the range we've been in for a long time. And either we hold here because it's business as usual, GDP growth 2%, everything's just, inflation's stable, the Fed's stable, or is growth going to accelerate? And we're going to go recover further in terms of higher yields into next year. It's possible we break higher, but the story I've had for the past several years is that beware excessive optimism or pessimism. When you get too optimistic, it's not likely to pan out. When you get too pessimistic, it's not likely to be that bad. And we're stuck in sort of this okay world. So when growth gets strong, don't expect it to keep accelerating. Don't expect it to collapse either.